If AI keeps growing at the speed it is today, the way most people invest their money might completely change. And that's exactly why I recently started changing how I manage my own investments. Over the past 35 years, I've made millions investing in the stock market. And almost all of that success came from one strategy: investing in a low-cost S&P 500 index fund. Historically, the S&P 500 has returned about 10% per year on average. Instead of trying to guess which company will win, you buy a small piece of the 500 largest companies in the United States. Some companies fail, some explode in value, but over time, the entire market grows and you benefit from that growth. For decades, this passive strategy has been incredibly effective, and it's the reason millions of investors rely on it today. But recently, something made me stop and rethink part of this strategy. After researching the rapid growth of AI, I reviewed my portfolio. In this video, I'm going to walk you through the 5 biggest changes I made because of AI, and what they mean for you. Stay with me until the end, because the final change I made might actually be the most important one for protecting your wealth. For every dollar invested into the S&P 500 today, about 40 cents of that money goes into just 10 companies. These include Nvidia, Microsoft, Apple, Amazon Alphabet, Meta, Tesla, Broadcom, Berkshire Hathaway, and JP Morgan. Nvidia alone can receive between 7 and 8 cents of every dollar invested. In the S&P 500, this is due to market cap weighting. Almost all of them are aggressively investing in one thing: artificial intelligence. Billions are being poured into infrastructure and chips. Investors are valuing these companies not based only on today's earnings, but on what they might earn if AI becomes truly powerful. To justify current valuations, they need to generate trillions in additional revenue. This introduces significant risk to the index. This can create a feedback loop. The bigger they get, the more money flows into them, pushing valuations even higher. So one change I made was slightly reducing the amount of new money I invest into the traditional S&P 500 index fund. One alternative is an equal-weighted S&P 500 fund. Instead of the largest companies dominating, every company receives roughly the same share. However, it requires constant rebalancing. Because of this, I also began looking beyond the United States. History shows economic leadership shifts. In the early 1900s, the UK dominated. In the late 1980s, Japan looked unstoppable. By investing in a global index fund, you gain exposure to thousands of companies across dozens of countries, including emerging markets. The third change focuses on opportunity. I'm paying attention to smaller companies that are applying AI in creative ways. Think about the internet. The biggest winners weren't always those laying cables, but the businesses that used it most effectively. Another area I've been increasing exposure to is gold. It acts as a store of value during periods of economic uncertainty. While I'm not predicting a dollar collapse, holding a small percentage of gold can act as insurance during volatile periods. The final change is increasing my cash reserves. Many underestimate the importance of liquidity when markets become unstable. At the end of the day, the truth is nobody knows exactly what the future holds. The smartest approach is preparation. By diversifying, I'm positioning my portfolio to handle multiple futures. The goal isn't guessing the future, it's being ready. Subscribe to the channel because next time I'll break down the exact strategy I'd use if I were starting from scratch today.